I remember that moment because it was very fascinating to me. And then I went to a blockchain explorer and I watched it settle on the blockchain. So that's sort of like this aha moment. I sort of liken this to like if you have a really strong opinion on crypto and you've never used a crypto product or you don't have a wallet, you've never sent a transaction. It's kind of like you have a really strong opinion on the internet and it's 1992 and you've never used a computer.
So why would you use the same methodologies that you have for stocks to a crypto asset class and expect a same apples to apples comparison? You can try, but of course you need to be open-minded enough to expect a different result. And that's what me and Michael are trying to do. We are not going to be perfect in our methodologies, just like how all the incumbent stock methodologies for valuing is not perfect. Welcome everyone to episode 10. We're now in double digits, Michael. How did that happen?
It happened fast. I don't know, man. Time is flying. I think we've been a pretty good luck charm for the crypto markets.
Yeah.
We now have Bitcoin ETF. So yeah, we are into month 3 of the rundown. How are you doing?
Pretty good, brother. Pretty good. So welcome everyone to episode 10 of the Rundown podcast with Shiv and Michael. Michael, by the way, is now a LinkedIn top voice. So congratulations, first of all, to you, Michael, on that very compliment-worthy feat. Not many people are LinkedIn top voice. I think you're the first crypto YouTuber / crypto analyst that has got the honor from LinkedIn for that. So many congratulations to you.
Appreciate that. Yeah, I have no idea if I'm the first crypto person on LinkedIn to get it, but no, it feels good to get recognition from LinkedIn. And yeah, thank you to LinkedIn for that.
Amazing. So guys, we've got a power-packed episode today. Of course, we are recording this episode for the first time. We are meeting each other for the first time after the amazing Bitcoin ETF announcement, which a lot of people were excited initially, but as we have seen since the announcement, it's been more of the sell the news event. And so the people who were just like Bitcoin tourists are like sad about it. But I'm sure you and me, who've been in the industry since 2016, we're ecstatic about it.
I'm excited. This is one of those like kind of line in the sand moments, I think, for Bitcoin, for crypto at large. You know, we are on kind of the main stage now at this point with an ETF in the market. Last week, of course, we record a few days before these things are published. So we weren't able to talk about it last week. So I think it makes sense to just do a full debrief of the Bitcoin ETF. And maybe we could just start with some of the kind of like numbers of like kind of what transpired, because I think you're right. Like the big question going into it was, is this a, buy the rumor, sell the news type of event? It turned out to largely be that, I would say. I think Bitcoin went up a little bit like the day after, like it was Thursday, the January 11th, went up a little bit, but then it was a quick sell off from there. And I think we've sold off, I don't know, maybe close to 10% or something like that. But no, I think overall successful. So there was a lot of like discussion around, is this going to be the most like the most popular ETF like ever launched? A lot of people were projecting $1 to $2 billion of inflows into the ETF on day one. We did not get to the $1 billion mark. It got to 655 million. That's what Wall Street Journal had reported. There's been some different kind of reporting on those figures because there were like sort of offsetting inflows and outflows from the GBTC conversion. So I've seen some other numbers that are saying it's much higher than that, but I think it's offset by sort of the net flows there. But yeah, 655 million inflows day one, 4.6 billion in trading volume on day one. So a good amount of trading volume there. And like Bitcoin trading volume in total was up as well. So like 50 billion or so the day of around that mark, the second day as well. So we now have 11. The SEC issued all 11 applicants were approved. We now have 11 of these products now in the market. That means there's 11, sales teams on Wall Street that are now evangelizing Bitcoin, putting together pitch decks about Bitcoin and the investment case for Bitcoin and pitching this to their investors and their clients, which is pretty fascinating. Bitwise, which is a crypto native advisory firm, was number one in terms of flows on day one. They did over 200 million of flows. So they beat BlackRock, they beat Fidelity, which is pretty interesting. There is a fee battle, going on here. So I think the fees are ranging from about 20 basis points up to 150 basis points. That 150 is the Grayscale conversion fee. They converted that to an ETF, but their fees are much higher than the other ETFs, primarily, I think, because to get out of that ETF and convert over to a cheaper fee ETF, there's going to be a tax event for people that are in that trust right now, or the trust that was converted. And so Grayscale is sort of holding them hostage, I think, a little bit there. And then a few of these ETFs, like Bitwise, they actually got rid of the fees initially. So it's 0 fees initially, and that's probably why they were able to get those inflows. But I'll pause there. Just, I think in general, it was sort of a sell the news event, but also like it did well. Like in terms of like, if you compare this to like average ETF that gets issued, this was, probably the top 1% in terms of, volumes and inflows. So I'll pause there to get some of your thoughts as well.
Yeah, just quickly, I want to provide a parallel example of what happened during Facebook IPO, and I need your help. Who is the owner of Dallas Mavericks? I'm sorry, I'm forgetting his name.
Mark Cuban.
Mark Cuban, yes, the Shark Tank, Mark Cuban. I remember, and people can Google it. I'm pretty sure this video would be on YouTube as well. When Facebook IPO happened, it rose a lot during IPO day, and then in the subsequent days, it went down. And Mark Cuban went on record and said that he sold his Facebook stocks because it was a trade. Cut to the next 5 to 6 years, Facebook went up 5x, 6x. So I think a lot of people who are just in Bitcoin because they thought that we're going to trade Bitcoin ETF because of all the hula, and they exited, I feel they're going to find the same fate as Mark Cuban found with Facebook, because for them, it was just a trade, and that's why they didn't hold it longer. We're going to see Bitcoin 5, 6x, as we always talk about. The valuation is there, and that's what we're going to discuss in this episode about valuation.
Yeah, I think you're right. That's this short-term thinking never works with Bitcoin or with crypto at large. And like, if you thought it was a trade, then most likely you were part of the consensus in the market. You didn't have interesting information. I think one of the takeaways for me when you see these like buy the rumor, sell the news type of events is like that was the consensus in the market. So like if your logic for how you're going to like enter the market is the consensus, then you're offsides. You have to sort of the time to be interested in this was, probably a year ago or around then when nobody was talking about the ETF, right? So that's your non-consensus at that point. So that was kind of just like one of the takeaways in terms of like short-term impact. We talked a little bit about like the CME, like Bitcoin futures markets last week. I did take a look just to see like, was there a big change in the futures markets now that we have this spot ETF? Didn't really see anything notable. There was actually a bump in some of the futures contracts on January 11th, so the day after, but I didn't see like anything super notable there just yet, super early, but we'll see if like there's either more or less, futures trading moving forward. As I mentioned, like the spot trading for Bitcoin in general was up. It's still not anywhere near what we would see in like a really like bull market type setup, but it was definitely up. And then like the other kind of interesting thing I'm hearing is like Coinbase. So Coinbase sold off a little bit. Coinbase got up to I think $185 per share towards the end of last year. It's sold off. It's trading around $130 or so. So I think it's down pretty considerably. The narrative in the market here is that now that you have this ETF, the fees are cheaper to buy that ETF, easier to just like buy that through your brokerage account, then set up a Coinbase account, that this is negative for Coinbase. We'll see. I mean, maybe that's right. I'm sort of taking the other side of that. And, full disclosure, I do own some coin stock, but I think that Coinbase is actually becoming like an infrastructure company. I actually wrote about this when we covered Base, which is their L2 earlier last year. And people could check out that report, but they've done just such a really good job of diversifying their revenues away from just these trading fees that I think it's probably unlikely that this is like a major like negative catalyst for Coinbase. Again, long-term, short-term, certainly that's the narrative, but long-term, I think that'll be proven to be wrong. So that was the other thing. And then like, if you compare like gold, I think a lot of people are looking back at the gold ETF this was like 2004. When that product came into the market, did that hurt spot buying of actual gold? Like there's no evidence to show that like when Robinhood came out and made trading fees, free, did that impact Morgan Stanley and Charles Schwab? And like, we just don't see this evidence in the market. So I think Coinbase, we'll see long-term how that does, but I think they're sort of, this narrative is sort of short-sighted, I think. Yeah, curious to get your thoughts there. And then maybe we can talk a little bit about just more the long-term, which is really what you and I are always focused on, is more the long-term.
Absolutely. Look, I'm just going to make a quick point. I think you spoke very well about the short-term impact, and I've got similar views about it. But I just want to make a quick point, and that is about Coinbase. If a lot of our viewers have got a different information than what me and my friends have, or Michael, happy to get challenged on it. But from what I know, Coinbase Ventures, their portfolio is part of the Coinbase public stock, isn't it?
It should be, yeah. Any of those companies they've invested in, that's on their corporate balance sheet for sure. Yep.
They are one of the biggest Web3 startup investors, and we've got no idea how undervalued those stocks are when they become in fruition later on. So according to me, and this is not financial advice, we even got a disclaimer for all the DeFi Report Substack viewers, listeners who are still not subscribing to DeFi YouTube channel. What are you doing? We present so many charts, so much information, and we've got a disclaimer as well now that we don't provide financial advice. Subscribe to DeFi YouTube channel now. If you're listening on Substack, subscribe DeFi Report YouTube channel. And yeah, like for me, when I look at Coinbase as a stock, I don't own it because I'm not an American citizen and I don't want to get into that whole thing. I'm an Australian citizen, so I invest in Australian stocks or I invest in Bitcoin. I've got exposure in Bitcoin. But Coinbase, I don't own. But when I value it as a stock analyst kind of a person, I think Coinbase is very undervalued because I don't think we are fairly valuing the potential of all the investments that they've done as part of their Coinbase ventures as well.
Yeah, no, I think that's a good point. And yeah, they've just done a good job diversifying. I'll leave it at that. Like they've got this L2 now with Base, which if you're trying to value this L2 that's within the Ethereum ecosystem, there are comps in the market like Arbitrum and Optimism. We've talked about these on the show, where that's interesting when you start to like add that into Coinbase's valuation that you see on Yahoo Finance. There's a lot there, and they're building out infrastructure, and that this could build out into like real world asset tokenization, and they could sort of be a leader in there. So you almost have to be crypto native to do like fundamental analysis of Coinbase. And I think most analysts on Wall Street are not really that deep on it. So yeah, they look at the trading volumes, and that's sort of how they're valuing it. But yeah, let's talk a little bit more about like long-term kind of impacts of this ETF, because I think like, again, short-term, it's in the news, we had the sort of the sell the news event, but like the way that I sort of think of this, I like to compare it to like the halving. So the Bitcoin halving happens, and it's going to happen again this coming April, I think like around April 20th or so. So we're, a few months out from it. And that's when the, supply of new Bitcoins that are coming into the market is cut in half. Now, you would think like, okay, that's going to have an impact on price at the margin. Typically we go into a bull market after these halving events, but it doesn't happen immediately, right? So it's not like, the next day we reprice the Bitcoin market. I think it's similar with this ETF, where it's just sort of this like constant like new bid in the market. If you start to open up, if people start to invest in Bitcoin into their 401ks and things like that, it's kind of like this just automatic like new buyer that's in the market, and it's a much larger sort of like buyer on the margin there. But coming back to the halving, at current Bitcoin prices, the amount of new supply that's going to be reduced once we get to the halving comes out to about $7 billion of selling pressure per year at current prices. Most of the analysts out there that I've seen are projecting somewhere around $10 billion of new inflows through these ETFs into Bitcoin per year going forward. We'll see if that's accurate or not. So you could sort of say like, okay, if that's true and there's 10 billion of new buying, that's like 1.4 halvings if you just like use the halving number in terms of like the sell pressure that's being removed from the market. That's kind of interesting. So you have like 1.5 new halvings, happening every year for Bitcoin. That should do something obviously to the price over time. So that's kind of one way to think of it. You can kind of compare what happened with the gold ETFs in 2004 to try to get a little bit better feel for the more longer term impact. The ETF for gold came out in 2004, and it was kind of similar. If you look at the price charts of gold, like there was a little bit of a run up before the ETF, and then it looked like it was a sell the news event similar to Bitcoin. It kind of consolidated, and then it went on a massive bull market all the way up to like 2012, and gold went from like $400 per ounce up to $2,000 per ounce or so. So people are looking at that, maybe we see something similar for Bitcoin. But yeah, I think again, the big picture is this is like a long-term thing. Anybody who's held on to Bitcoin for more than 4 years has made money in Bitcoin. And it's a very much of that's how I think of Bitcoin. It's a long-term investment. But like the other piece of this is just the stigma of crypto and Bitcoin at large. Now that you have people like Larry Fink and BlackRock and these sales teams on Wall Street, basically making the investment case for Bitcoin, that just has an impact like investor psychology and just like the way that people think about crypto, like over the longer term. So I think that's kind of my long-term views here. But yeah, I'm curious, how do you see this impacting things post-halving? Maybe that's a question for you.
Yeah, you're right on the money there. Even if ETF wouldn't have happened, historically, if we look at the Bitcoin halving event, it's a bull event for Bitcoin because of the clear supply and demand thing. The supply gets decreased by 50%, which you alluded to. So even if ETF wouldn't have happened, it would have been a bull event this year and the next year for Bitcoin. And you're right, I have very fond memories of trading gold CFDs. In Australia, we call it contracts for differences. So I have very fond memory of trading gold contracts for differences, going long on it. And I remember it didn't peak at 2,000 US dollars. It was just a touch below 2,000 US dollars in 2011, 2012. And I used to be very big in the social networking platform called StockTwits at the moment. I think I still have a profile there. I've got around 5,000 followers over there starting from 2011. So look, I totally believe that Bitcoin is going to supersede the gold ETF performance because this is a better version of gold. It's portable, much easily transactable. Gold is not money. I know historically gold is treated as money, but in this age, gold is not a medium of exchange. Bitcoin is a medium of exchange in countries where it makes it a unit of account. Bitcoin is money, whether people like to believe it or not. You might defer to it. For me, Bitcoin was money, is money, and will be money. So I think people have got no clue. And I think any event that they think is a bear cycle for Bitcoin, for me, it's always a time to buy it. It was a time to buy it in 2011. It was a time to buy it in 2015 when it crashed. It was a time to buy in 2019. It was a time to buy in 2022 as well during the start. So for me, it's always bull. I don't see any other mathematically pure decentralized asset than Bitcoin. So by now, if any Bitcoin maxis are hearing, I can be part of your group, I think, after this, what I said.
Yeah, I think so. And that kind of brings up an interesting point there where you're saying, if you think it's money, you're probably not somebody who's going to buy the ETF. And the reason for this, and I don't think we're not recommending people buy it, we think you should just buy spot Bitcoin and hold it and self-custody the asset. But what's interesting about the ETF is that it's an in-kind redemption. So if you own the ETF, like the way most ETFs work, if you want to convert back, they give you the underlying asset. So if you own like the S&P 500 ETF, you actually get those shares if you want to get out. They're not letting you do this with Bitcoin. So you can't get the Bitcoin. So this isn't like if you view it as money, you don't want to buy that because you're just going to end up with dollars if you wanted to get out of the ETF. I mean, that's kind of one way to sort of control it a little bit with these financial products where if everybody's rushing, to get out of this thing and they want Bitcoin, you're not going to be able to do that. They're going to give you dollars and, we'll see what that looks like. But
I just want to quickly say, and because you raised an extremely valid point, and I just want to make a quick comment about it. And it's more for viewers who are experienced in crypto who watches the rundown as well, just quickly on it. I believe Bitcoin is an asset that should be stored in a self-custodial manner. That's how I store my Bitcoin. It's on a hardware wallet. But I am also aware, in order to store these things in a hardware wallet, everybody's tech savviness is different. So from that point of view, I applaud and congratulate the community that we've got a Bitcoin ETF, because in order to make this into a mature asset class, we need to have financial products around. While I recommend people to learn how to self-custody crypto assets, I'm also quite open-minded enough that if these markets need to be matured, they need to be regulated properly because the crypto industry has failed to self-regulate itself. It needs to have these financial products created by these traditional financial companies as well. So both need to coexist.
Yeah, I think that's spot on. People all over the world can get access to Bitcoin just by buying the underlying, self-custodying the asset. That's really unique that you can do that. And if you don't want to go through all that trouble, you can just buy it through your brokerage account. I think that's the best of both worlds. be honest. And now we have Kathy Wood out here saying that Bitcoin's going to go to, $600,000 or so. And so I think that was her like base case. Bull case was much more than that, which maybe that's a good segue into what we wanted to discuss going forward here is like intrinsic value. I think this is like something I've been wanting to talk a little bit about on the podcast. I put a post up on LinkedIn, and maybe I'll just, share my screen here.
For all those DeFi Report Substack podcast listeners, go to DeFi Report YouTube, subscribe, and look at the visuals that Michael is sharing right now.
Exactly. And yeah, I just pulled up LinkedIn. So like I put a post up. This was right after the ETF was approved last week. And of course, like it reminded me of the like bull market of last cycle where there's more like kind of the no coiner, we call them no coiners, the people that just really like don't like crypto, and they'll come into your comments and tell you usually like something just like Bitcoin has no intrinsic value. Right. So it's almost like they think that if they say those two words, intrinsic value, that it's like some sort of mic drop moment and like nothing else matters. So if you can't have a discussion about it because it doesn't have intrinsic value. So anyway, it's an interesting topic, this intrinsic value. I put a post up on LinkedIn. It's a little bit of a philosophical type of post going into like, what is intrinsic value? Like, does the fact that Bitcoin has a $914 million, was at the time, market cap, but because that value is not intrinsic, that means the market cap is zero. What if Bitcoin's market cap was a penny? It's not intrinsic. Does that mean Bitcoin's overvalued if it's a penny? So it's a fascinating sort of discussion. And it comes back to like, what is intrinsic value? Like, what is intrinsic value? What do these people even mean? Because the way I think of value is subjective. There's no such thing as intrinsic value in my mind. What intrinsic value actually is a social construct that really was a way for investors to gain consensus around how to value businesses. And this was really Benjamin Graham in the 1930s. wrote a book called Securities Analysis. And this is where he was proposing these ideas on how to value businesses using cash flows and discount cash flow analysis, which made sense to people because of the time value of money and because of the ability to do relative valuations of various businesses with that methodology. So that stuck. This term intrinsic value was spawned out of that, but this is someone's idea. It's always important to realize that like everything around us in society is basically someone's idea that then we created a social construct around. We came to consensus around that idea. It doesn't mean that that can't be broken or that some other idea could have achieved that type of consensus. So I think it's kind of interesting. So that's like what intrinsic value is. Well, then it's like, well, what is Bitcoin? Well, Bitcoin is a social construct. It's one way to view Bitcoin. And why is it a social construct? Because people agree with this idea of sort of having this new version of money that's outside of the sovereign control. It's sort of outside the system, and it has these properties based on how many units there will ever be of this thing. So the value of it cannot be diluted, and it has this proof of work mechanism to it and this ability to mine it. It's an idea. It's also a technology. And it has these properties that people have come to consensus around. And that's why it has this valuation in the market. Is that valuation going to go down or up? Like, who knows? But to say it doesn't have intrinsic value and that therefore it's just like we shouldn't even be talking about it is bizarre to me. And so I think it's an interesting discussion. We're going to go on chain here in a moment and just get into a broader discussion around like valuation in crypto. Yeah, I wanted to kind of get your thoughts on like this intrinsic value. This is something we're going to see more of in a bull market,
Yeah, absolutely. So I'm going to be quick. I did my MBA at NYU Stern School of Business from your country, New York City in America. And Professor Damodaran, who's considered the Dean of Valuation, who teaches valuation at NYU, he speaks often that valuation is a craft. It's a craft because it's a mixture of art and science. And I've written a book on the history and evolution of money. So I know a thing or two about how capital markets have evolved, how methodologies, and you quite well said, Benjamin Graham books was instrumental, the Dow-Joe theory, the work afterwards that was done by various Nobel laureates on evaluation of modern portfolio theory. All of that have been instrumental work. But I put out this question to all the viewers, all the DeFi Report viewers and the Proof of Work podcast viewers as well. Name me one valuation framework that is able to predict market value with 100% certainty. There is not even a single valuation framework. And equity as an asset class has been there for hundreds of years. Valuation frameworks for them have continuously evolved. Why? Because like you often say, it's market sentiments dictate. There are just so many variables. And like your post quite well articulated, and I also believe that, valuation is a social contract. Why does a Michelangelo painting get sold for $400 million? What's the intrinsic value in that? It's a social contract. Some art appraisers would say it's because of this and that. Ask a CFA. You and I get trolled a lot by CFAs, right? And the reason for that is, and this is nothing against CFA Institute, but they don't really know the fundamentals of crypto asset. Crypto asset is the first asset in the history of capital markets that was brought to Wall Street sort of a machinery by the retail investors. The first 15 years of Bitcoin, it is us, retail investors, that brought it to the light of Wall Street machinery and changed the minds of people like Larry Fink that went from crypto is not an asset class to now crypto is a universal asset class. So it requires open-mindedness. Bitcoin ETF marks a new paradigm in financial markets where we are going to see more and more cypherpunk and, movements from retail investors that are going to bring these assets to the Wall Street machinery rather than the other way around because of the advent of Web3 decentralized internet. So yeah, I just thought of quickly pointing that out.
Yeah, and I think it's a good point on like the CFAs and stuff. I think what ends up happening is they get so stuck in sort of this academic exercise of what they've been taught that they just lose the forest for the trees in terms of like realizing that value is subjective. And like, this isn't some like a science. Like you can't just apply something and then convince somebody. Like if people say something's worth something, that is what it's worth. That's how the markets work. I think it brings up a broader discussion as well on just like crypto valuations in general. And like, this is a topic that I get into in detail in the Ethereum investment framework as well, which we update that quarterly for people that may not be aware of it. We update this framework quarterly. It's going to be the Q4 update is going to go out next week. So we'll have a lot more to share on this, but maybe this is a good way to segue into our going on chain segment. I think most people know Bitcoin is sort of separate and unique from the rest of the crypto asset class because if you're not mining it, you don't have any access to those cash flows. Things like Ethereum are slightly different. And so we'd love to get into this discussion by going on chain. What do you say? Should we go on chain?
Let's go on chain with Token Terminal, Mike.
I'll see you in the terminal. Kind of just like taking this conversation a step further here. We're just looking at Ethereum here back into the token terminal. And, if you're a traditional investor, how should you be thinking about valuing something like Ethereum? How should you think about its value today? And how would you think about whether that's something that's overvalued or undervalued? And I'm going to start this with I think this is the CFA view, the CFA who's not super curious and is taking a very academic approach towards crypto. This is how they would view this in my opinion. So we're up here at the top of this is like the market summary that Token Terminal provides and with some of these metrics. And like price to sales ratio is a ratio that a traditional investor would understand and how they might look at a traditional stock that with a cash flow. As we know, Ethereum has cash flow, therefore we have this metric. And what this is looking at, the way this is getting calculated is it's just extrapolating out 365-day fees and then the market cap divided by those 365-day fees. So if you're a traditional investor, you might look at this and say, if I want to buy Ethereum at $2,567, I'm paying $119 for every $1 of fees that Ethereum produces. And most people would say that's absurd. It's overvalued. Pass, right? I'm not interested in that. It just looks like a super overvalued tech stock or something. So that's kind of like the way I think most sort of traditional finance investors would think of this. To me, there's just a much, more nuanced way to explore valuation of crypto markets. And I think this same sort of viewpoint would have been applied to Amazon in the early 2000s as well. It would have looked similar to this. And everybody knows that if you had just held on to Amazon back then, you would have done really, really well. The way that I try to think of this is there's a number of sort of angles you could come at here. You could look at this and say, okay, it's trading at 119 times its sales. Is this thing actually trading on cash flows or is it trading on something else? And I would say it's not trading on its cash flows because it's also, $2,500 market price right now is still significantly off its all-time highs. And so it's the question starts to become, well, what is it trading off of? Is it trading off of some sort of total addressable market analysis? This is something we go through in the Ethereum investment framework where we essentially look at all of the various industries that, can be impacted by something like Ethereum. And then we back into what that looks like if some of those revenues end up on chain, what's Ethereum's take rate, and we get to like a valuation that way. You could do a relative valuation, right? So you could look at it and say, well, what are other network technologies or platform type businesses? Things like Apple, like the App Store is essentially a platform. Other people build products and services on top of that. The App Store takes a fee. It's somewhat applicable to like how you would think about Ethereum, something like Amazon and, Amazon Web Services and how they take a small fee for providing services and people are building on top. Kind of a similar, you could come to a relative valuation that way. So that's another way to kind of think about valuation. And then the other piece of this is if you stake the asset, so if you were to go out and buy, an Ethereum, you could then stake the asset into a validator contract. Now you're providing services to the network and validating transactions, and you earn a yield for doing that. That yield over the last year has sort of fluctuated between 4 and 5% or so. So that would be another way to think about, how you would potentially value that asset. What is the right way to do it? We don't know, right? Like I think the answer here is that we don't know. If you do this total addressable market analysis, which I have done, and it's in the Ethereum investment framework, you get to a pretty interesting number, and it's much higher than what we see today. If you do the cash flow analysis and you just extrapolate it out, Ethereum's 365-day cash flows, which are 2.4 billion, you would get to a lower valuation. If I did a 20-year discount cash flow analysis and applied a 25% growth rate to that, and then projected out how many tokens are going to be circulating, it would actually come out lower than the current market price. So you look at that, that's the traditional methodology. Doing a relative valuation, you might look at that and say, okay, that's kind of interesting. Like it's about 10% of the value of some of these existing network technologies out there. And then the other thing to think about is like the sort of GDP, gross domestic product type of analysis here, where Ethereum is sort of like this base layer technology. There are layer 2 blockchains that are sort of being built on top of it. There's applications, and all of those things have their own revenues. And so you could look at it and say, okay, Ethereum has about $2.5 billion of gross domestic product built on top of it. And then you could do a relative valuation against other, layer 1 blockchains and then kind of take that type of approach. But the key thing for me is just like, we don't know. We don't know what this is a new thing. The thing that I always come back to that is probably the best way to think about this is that it's not going to be an analogy. Like using an analogy to try to value a new technology, probably the wrong thing to do. So if you're using just discount cash flow analysis, I think that's wrong. It's useful to do the analysis to see where it sits and then do other analysis. But I'm curious how you would think about this. I have gone through this and like gone through 4 or 5 different methodologies and looked at that, and we go through that in the Ethereum investment framework. And I think that's the best way because eventually the market will come to some sort of consensus, a social construct, which we talked about, but that hasn't really happened just yet.
So look, I probably am going to spend at least 5 minutes addressing this. I hope I spend less than that. So first of all, to all of the listeners and viewers on both of our socials, I'm super excited for Ethereum investment framework to come. Me and Michael, we bonded initially because of the Ethereum investment framework, which seems like you came on my podcast during the last quarter ages ago. But that's how we bonded for the Ethereum investment framework. So I'm pumped for Ethereum investment framework report to come next week. We're going to do a deep dive next week about that. Now that I've discussed about that, I just want to say I'm probably not doing myself any favors because CFA Institute will eventually incorporate crypto assets as a chapter in there. And I'm probably kissing my chances of being a contributor in that goodbye by saying what I'm about to say. But I just have a question for all the, those academic analysts out there. Do you use DCF to predict the price movements of gold ETF? No, you can't use DCF to value commodities. Why? Because commodities as an asset class is different to stocks as an asset class. Do you use DCF to predict the price movements of whether the Euro USD pair will go up or down? No, you can't do that because DCF doesn't apply to currency as an asset class. So why would you use the same methodologies that you have for stocks to a crypto asset class and expect a same apples to apples comparison? You can try, but of course you need to be open-minded enough to expect a different result. And that's what me and Michael are trying to do. We are not going to be perfect in our methodologies, just like how all the incumbent stock methodologies for valuing is not perfect. If it was perfect, then all the CFA people would be billionaires by now. But not many CFAs are successful investment managers. They might be good research analysts, but they're not successful investment managers. Successful investment people are the ones that are able to value not only the fundamentals, but they're able to time the market well as well. Otherwise, you're good with an index ETF or a Bitcoin spot ETF now. I hope I don't come across as ranting, but this is a conversation that I've had a lot of times with my MBA friends in both Australia and in US who get so religious about the academics that they forget to reason with common sense. And so it's very important to apply common sense no matter how much religiously you have done your PhD or been academic about things. And I just want to say that some of the top hedge fund managers, and most of them are from US, hail from US, they all are not too academic about their investment decisions. They apply common sense along with fundamental analysis layer. And that's what we do at the Rundown and the DeFi report and the Ethereum investment framework. So it's by no means would ever be perfect, but we are laying down the foundation to value this from a fundamental lens so that you as a reader can evaluate whether they are fundamentally valued, overvalued, or undervalued. But it would not be able to tell you whether the market value would be at this price or not. If it was, then we would not be doing the Rundown podcast. We will be sitting in a Caribbean island and just sipping, pina coladas or something else.
Yeah, no, I totally agree. And like the other thing I think, a traditional investor might look at here, especially looking at this like price to sales ratio, and they would say, well, do I have legal rights to dividends and cash flow or liquidation preferences, things that you typically get when you own a stock? And then the answer to that is also no. If you own that asset, you are self-custodying it, so you have control over that, and then you can stake it into a validating contract and earn that yield. There's some smart contract risks that you have to take on to get that yield. But that's the other piece of it that I think throws people off as well, is that these are different types of assets. There's no like legal rights that come with these. That's the blockchain is the law in some ways.
Can I just quickly ask you, Michael, because you are now a LinkedIn top voice, so it would matter a lot if you also agree with this. I know we have discussed this privately, but would you agree that for all of our listeners and viewers that are still sitting on the sidelines of crypto and are watching our podcast and are getting enlightened, and we get amazing feedback that what we are doing is amazing with on-chain data, especially you, would it be fair to say that if somebody is reading a research report by anybody and says that this is not the asset class to invest in, or do not invest in Ethereum, or do not invest in this thing, would it be fair for those viewers and listeners to go back to that research analyst and ask, have you bought a crypto asset?
Yeah, I think it is fair. Or do you have a wallet, right? Have you used crypto? Because you have to use this stuff. I remember the first time I sent a Bitcoin transaction, I remember that moment because it was very fascinating to me. And then I went to a blockchain explorer and I watched it settle on the blockchain. So that's sort of like this aha moment. I sort of liken this to like if you have a really strong opinion on crypto and you've never used a crypto product, or you don't have a wallet, you've never sent a transaction, it's kind of like you have a really strong opinion on the internet and it's 1992 and you've never used a computer, right? So like, why do you feel you have this authority to sort of have that strong opinions? I think just, coming back to the valuation as well, like I like to ask myself the question of like, well, what is something like Ethereum worth if this is a, global network that can serve as like a foundational accounting system for all of the world's assets? It can connect 8 billion people in a peer-to-peer manner. It's been around now for almost 8 years. So it's established itself as this, decentralized, secure. It has some Lindy effects to it, has these like really massive network effects. It's scaling in a way that's sort of the way that the internet scaled out. And then in terms of like the use cases for finance and the ability to, account for all of the world's assets, everybody's identity can go on these blockchains, be used for voting systems. I think eventually these will transform almost every business model on the internet because you're implementing this like new economic layer where people can have digital property rights. So the use cases, the total addressable market of these types of things is probably much larger than we can even predict. Maybe I'm wrong. Maybe it's less. But I think like there's examples of this going back to like Uber and Airbnb and people trying to figure out what is like the market value of like should Airbnb, it was probably reasonable to look at Airbnb and say like, why would this thing be priced more than Hilton? And that was just not the right way. You're using analogies and you're totally missing the forest for the trees. They don't own any hotels, but they're priced more. They have a higher market value. Same thing with Uber. They don't own any taxis, but they're worth much more than the entire taxi industry. So anyways, that's kind of one way to sort of think through this. I'll just pull up a few more comps here because they get even more like out there. Like when you look at Solana, for example, you know, the price to sales ratio of Solana is 694. X. That's a pretty high price of sale. So again, the traditional investor looks at that and says, okay, if I want to buy Solana at $96 or $97, I'm paying $694 for every dollar of fees that this thing earns. And they would laugh at that and say this thing should be worth like $1. But again, potentially missing the forest for the trees. There's a meme that, you know, you've probably seen the bell curve, the crypto bell curve meme. And it's got like the dumb guy on the left side that just says crypto's good. Like, yeah, meme coins, like let's buy them. Then you have the sort of far side of the bell curve, which is doing all this fundamental analysis and like coming to the same conclusion. Yes, crypto is going to be this big thing. Then 80% of the people are the like MBAs and the CFAs in the middle doing this type of analysis saying, how could this be worth anything? I have to pay $694 for $1 of fees. Like, I'm just going to pass. And then it goes up 20x. The more like scientific your thinking approach is, the more you're going to miss the forest for the trees, I think, in general. You know, just moving on to like Avalanche. This is another, these are just L1 comps. I'm just sharing. This one's down to $52, which is interesting. Their price to sell is 52x, partly because Avalanche has seen, you know, a lot of on-chain activity. So this gets skewed a little bit. I think that's a little bit skewed. I think it's actually much higher than that if you factor in the past 365 days. And then, you know, we can kind of go into some DeFi protocols here as well. I wanted to share how that starts to change with fundamentals when we look at the DeFi protocols. So yeah, so just looking at Uniswap, this is one of the like, you know, the OG DeFi protocols. We just looked at some of those L1s that have like really high, you know, price to sales, price to fee ratios. Uniswap is at 6.67 for its price to fee ratio. That's in line with Apple, you know, Tesla, Netflix, those types of companies. So that actually gets sort of a little bit more interesting. It's a $6 billion market cap. You know, how does an investor look at Uniswap? They would probably look at this and say, you know, it did $588 million in fees over the last year. If I buy the token, what does that mean? And this is the challenge with Uniswap, is that it means really nothing in terms of your access to those cash flows. All of those cash flows are going to liquidity providers that provided services to the network. So if you just own the token, there's no, you know, sort of cash flow mechanism for you to access those fees as you would with Ethereum, right? You can't stake your Uni token. I think we'll see this in the future with Uniswap. So an investor will be thinking about like, how does this fee switch, you know, sort of change in the future where then that yield can be captured by the token holder? We'll see. But interesting to me that just the way these are priced, very different from an L1. Right. It's a much more reasonable type of valuation. And then if I look at Lido Finance, Lido is the largest liquid staking provider within Ethereum. So if you look at the price to fee ratio, it's 3.7. That's pretty low. That's pretty reasonable. I mean, it's because Lido did $644 million in fees. You know, those fees are coming from the yield off of the Ethereum stake rate. So they paid out $644 million in fees. That number is probably going to go to $1 billion. So you're going to have a crypto protocol kicking off $1 billion in cash flows probably next year, because those fees will go up. If the Ethereum price goes up, that's what those fees are denominated in. So that could go up really fast. It's pretty fascinating that we're going to start to see crypto DeFi protocols producing $1 billion. I think MakerDAO has a chance to do $1 billion in revenue as well. Uniswap. So we could have 3 to 5 protocols doing $1 billion, not $1 billion in market value, $1 billion in revenue per year. So anyways, just another sort of way to contrast the valuations here. This one looks pretty interesting. We can probably wrap up there and just talk a little bit about like, you know, where is this all going? We have fundamental analysis. We have these on-chain data providers like Token Terminal. Yeah, curious if you had anything to add with these DeFi.
Just quickly, I'm super excited. We're going to be covering this every week. Thanks to you, thanks to our data providers, Token Terminal, our partners in this. There's going to be one repository that is not going to draw lines on a chart and tell you when things are going to go to the moon. We're going to be providing this analysis week after week, and we're going to see the progress of this bull cycle, which is going to be different to the previous bull cycle, at least from a personal point of view, because we're going to actively monitor the fundamental lens week after week, and all of our combined subscribers of DeFi Report and Proof of Work are going to get all this valuable information. So again, DeFi Report Substack audio podcast listeners, subscribe to the DeFi Report YouTube channel so that you can look at all those visuals that Michael is doing. I want all of those 5,000 Substack followers to hit the subscribe button so that DeFi Report YouTube channel gets 5,000 YouTube subscribers soon.
I promise I didn't pay Shiv to be my hype guy for this episode as well, so I appreciate it, Shiv. But yeah, no, I think we could probably wrap up there. I think for me, it's like we're not telling people like this is how to do it. We're just a little more curious probably than most, and so we're taking a very open-minded approach.
And I'm sorry, I'm gonna use this word. We both care about this industry more than our personal bank balances. That's why we focus on doing this, rather than taking any sponsor, Tom, Dick, and Harry, to pump their tokens.
Yeah, and I think, we'll see where this all starts to shake out, but it's important to realize that there was a time where people didn't really have consensus in the market on how to value stocks. And it wasn't that long ago. Stock markets have been around since the 1600s. Ben Graham, was writing securities analysis in the 1930s. So, my view is that we have these providers such as Token Terminal, we have fundamental analysis. People are building indices based on projects with fundamental. So I think that there will be some sort of consensus eventually on how to value these things, and they're going to be around for a very long time. And if you have more on-chain businesses in the future, that gets very interesting in terms of like this type of analysis. You're going to have all these analysts, all these young kids coming out of college that have been studying finance, maybe doing fundamental analysis of on-chain businesses in the future. And that's super exciting.
Yeah. So a quick 1-minute summary of the key takeaways that you said, Michael. We're going to see new valuation methodologies coming up, not drawing dinosaur patterns on technical analysis charts, but actual fundamental valuation methodologies for crypto assets. We're going to see the normalization of on-chain data. We're going to see more and more people getting into this profession of providing on-chain fundamental analysis. We are just the first one, and sorry I'm saying it. It may come across as arrogant, but we are the world's first crypto fundamentals educational podcast. So in a way, we trailblaze that. There is going to be more importance of projects that list with data providers, such as our partners, Token Terminal. Indices are going to be built on fundamentals, such as the ones that we are discussing. And for all of our no-coiners or all of our friends who believe that spending 300 hours reading about how to analyze valuation for a different asset class will help you analyze crypto assets using analogies and past methods are not going to be useful. For you, crypto is going to do what crypto has been doing for the last 15 years, which is continue on its bull run, but it's not going to be useful for you because your bias is going to limit you and your potential to actually be an early majority in this asset class. Nobody else, you're not doing yourself any favors. With that, I think this was a good show, wasn't it, Michael?
Great show. I think, to wrap that up, I always leave people when I write the DeFi report, stay curious. I think that's the most important thing with something like crypto or a new innovation. Stay curious, and maybe we can leave it with that.
Stay curious, guys, as Michael said. Keep on giving us your feedback. If you do not like me as a host, please let me know how I can improve, and we'll continue to improve. I do want to take a moment and thank our other team members as well, Michael. So Gian, Nicole, JC, and Paolo, the 4 team members that help us produce such an impeccable podcast episode week after week. So cheers to them. Yeah, if nothing more to add, Michael, we're going to see each other next week with more amazing stuff.
We'll see you next week, and we'll see everyone else next week. Thanks, guys.